Thanks for tuning into yet another episode of Insight. I'm Niraj Shah, and we've got a very interesting conversation going today. I'm privy, of course, to the content, and the conversation is with Ashwini Agarwal of Demeter Advisors. He is choosing to focus on the real estate space and the business of a company, which is not often spoken about, and which is why both the conversation with Ashwini about why does he think that the business of that company is looking interesting, and with the management of that company about what are the nuts and bolts around the operations and the outlook ahead, both sound very promising. Ashwini, great having you. Thank you so much for taking the time out.
Thank you, Niraj, thank you for having me on this show.
And the pleasure is ours. So, Ashwini, real estate, a lot of people are extremely constructive on it. It seems that you must be constructive on it for you choosing a company within that space, but you're also choosing a company who not too many people would say that is a pure play real estate name. So tell us a bit about this.
Okay, so coming first to your question on the industry, in my experience watching the real estate industry and the markets over the last 30 years, real estate tends to be very, very long cycles. So they typically are, 5 to 10 year cycles. If you think about it, we had a boom in real estate from, let's say, 1990 all the way through till 96, 97. And then we had a slump between 97 and say about 2004. And then again, a boom that started in 2003, 4, and then ended sometime in 2010, 11. And after that, a lost decade. Real estate demand has started to come back pretty much somewhere in the middle of the COVID. Uh, Individuals started to realize that they needed bigger homes and so on and so forth. And that spurred real estate activity. Also, the fact is that affordability over the last decade has gone up a lot. Income levels went up, real estate prices did not. So, and the interest rates went down. So combination of all this brought affordability into play. So real estate is at a very interesting juncture. And the company that I wanted to discuss is Max Ventures. But before I do that, I do want to provide a standard disclosure. Number one, I do have ownership of these shares, so that's something that your viewers should be aware about. This is not a recommendation to either buy or sell the shares. This insight discussion is purely to examine what's going on in the company. And I would recommend to your viewers that they take due care and discretion in taking any investment decision about this company. So that's how I would like to start. Max Ventures is very interesting to me because it's relatively unknown, but in the Delhi micro market, it is a company which has a very formidable reputation because it belongs to the Analjit Singh Group. The brand stands for quality, stands for premium, and that kind of plays to the strength in the real estate business. Right now, they have a couple of commercial properties that are up and running, grade A plus type of office spaces. If you go and visit these office spaces, you can compare them to the best, not just in India, but in most parts of the world. They have 7 projects which are at various stages of development, and all of this will mean a significant amount of growth over the next 5 to 6 years. And lastly, again, referring to your opening comment about it not being a pure play real estate company, I would like to state that it doesn't have any other business than real estate development at this point in time. They had a flexible packaging business which has been sold off. Bulk of the money has been received. A small amount is pending. They had a couple of other businesses which have all been hived off. There's a small investment arm which we'll speak about hopefully on the show. But outside of that, it's a pure focused real estate company across commercial and residential. So that's kind of a broad introduction.
Okay, thanks for that. Now, viewers, let's get in Sahil Vachani. He's the MD and CEO of Max Ventures. Let's get him in on the show. Remember, this conversation is about the business of Max Ventures, not as much about the stock. Sure, stock price may follow the business, but here we are talking about the business and I think getting insights from Ashwini about how good or how strong the business and differentiated could it be. Sahil, great having you. Thank you for taking the time out. I'm Niraj, of course, and Our guest today, Ashwini Agarwal, just before you joined, was talking at length about how over the course of the next 4 to 5 years, there are a bunch of things happening within your firm, which is that the growth numbers could look spectacular. Your brand positioning being very niche has a lot of acceptance in the Delhi NCR market. And there are also some other businesses like the investment business, etc., which he was hoping to talk about. Can you tell us from your perspective, how do you see the next 4 to 5 years for your firm?
Niraj and Ashwini, and pleasure to be here. Thank you for speaking to me. Um, yes, the Max Venture story has evolved over the last few years to now become that of a very focused real estate player in the national capital region, and quite different to how the Max Group was in a sense over the last 20 years, where the group was in multiple businesses. We believe that in the current times, we want to go deeper and really focus on the real estate business in the geography of the national capital region. And we'll talk a little bit more about the strengths and opportunities that we have. So that's how the company evolved. We had a packaging business, which we exited in two tranches to a Japanese partner, Topan, which enabled us to raise the capital. We subsequently raised further capital from our equity partner, New York Life Insurance, and now are in the process of directly listing Max Life, although it's quasi-directly listed through Max Ventures and Industries today. But our attempt is by the end of the first quarter of the coming of this current financial year, we should be able to directly list Max Estates as a brand and as a business through a merger between Max Ventures and Industries and Max Estates.
Okay. Okay. And just before Ashwini gets into the act of being the anchor as well, may I ask you, Sahil, how do you see growth per se? Everybody talks about how real estate as a cycle looks fairly strong, both for Pan India as well as focus players. To your mind, since you're a pure play real estate company now, how do you look at the cycle?
We think that fundamentally the strength of India, the Indian economy, will augur well for an industry like real estate. There has been, for lack of a better word, a significant churn in the real estate business, where there were a large number of developers, even in a geography like National Capital Region, 10, 15 years ago, which has now been consolidated to a few. So we're very confident that with the economic tailwinds, with the supply consolidation, and with the infrastructure or government framework of RERA, of GST, it provides a very strong and level playing field for good, strong corporate developers. So we are very confident at a structural level about real estate doing well at an economic level. And secondly, within that, we feel that developers who are focused on end customer experiences, who are focused on the right product and value, will be able to drive momentum and sales.
Okay. Ashwini, any thoughts, any questions?
Yes, yes. Thank you, Sahil. Good to see you again. What I would like to ask is that what does the Max brand stand for? And your annual report and all your presentations, you speak about work well, live well philosophy. How do you work on that? How do you put that into effect? And what does that mean for your business? And what does that mean for your shareholders?
That's a great question. Thank you, Ashwini. Lovely to see you again. So, if you look at what has been the spirit behind the Max brand over the last 25, 30 years, it's been about wanting to make a positive change in society. It's about enabling to move the needle of society forward. And that, therefore, through businesses like healthcare, health insurance, senior living, and life insurance, the group has done that over the last 2.5 decades or more, and even before that with telecom. We believe that the time is right now for us to continue to do that in the space of real estate, which in our belief is ripe for such a movement, if we can call it that. And our philosophy and ideology is very simple. It is to bring elements of wellness and well-being into the real estate space.
Great, great. So in terms of shareholders and shareholder returns, what you're really saying is that you build a quality workspace and quality home space, which should attract a premium, and therefore it translates into financial rewards for shareholders. So the other thing I wanted to ask is that in all your commercial projects, or several of your commercial projects, you have Max New York Life Insurance as a minority partner. So they provide capital for growth once you have conceived the project and all the acquisition-related issues and approval-related issues are in place. So there are two questions here. One is that what kind of returns does an overseas investor like Max New York Life look at? And number two is that would you look at other partners in your residential business for similar financial partnerships, which might reduce your need to go for debt at any point?
Yeah, absolutely. So New York Life has been a long cherished partner of the Max Group. As you may recall, in the year 2000, when we launched the life insurance business, they were a partner. It was at then called Max New York Life Insurance. Subsequently, in 2011, 2012, they exited that business as part of a global strategy of not being in operating life insurance businesses. But when we started the real estate business, they came in as an anchor investor. So as a shareholder, they do own about 23% in the listed company. And subsequently, we have also raised three additional tranches of capital at a co-invest level of commercial real estate. As an insurance company, they have to balance their asset and liability for a long term, and therefore they are very bullish on an asset class like office real estate, where one can get an annuity income in a sense from an investment perspective, and is also long term in that sense. The returns that they have already earned with us, if I look at the first journey, that they earned more than 20% dollar IRRs with us when they were in the life insurance business, and as we stand currently, their unrealized gains are close to 20% plus already in Max Ventures and in Max Estates. And our philosophy is that given that office spaces are more capital intensive, we would like to continue to partner with New York Life Insurance to look at an equity approach at an SPV level, and also for the listed company to earn development management fees, and therefore reduce the risk, so to speak, and the capital deployment moving forward. In terms of residential, absolutely. I think where we are today is that we've raised a substantial amount of equity through the exit of our packaging business, and therefore we've been able to do the residential projects on our own balance sheet. In times to come, we will definitely, as we have been, open to equity partnerships, but we also believe that in residential, the opportunities of joint development are open to us, which we have already demonstrated through what we have signed in Gurgaon. So residential and commercial are our focus areas, and we're very cherished to have New York Life as an anchor partner with us.
Ashwini, sorry, just before you ask the next question, I have a question for Sahil and for you as well. But Sahil, very quickly, so this New York Life partnership, when I was doing my research, and maybe I didn't find it or didn't like right places, but in your properties that you have, New York Life is a partner in a majority of them, all of them, or very few of them currently?
Yep. So in the commercial properties, in the office properties, New York Life is a partner in 3 projects. Out of 5.
Okay.
Square, which is a development which has recently got completed. New York Life is a 49% partner, and our listed entity is 51%. And then in the 2 subsequent developments that we have announced, one in Noida and one in Gurgaon on Golf Course Extension, on both, New York Life is a 49% JV partner.
Okay, great. Ashwini, just before you ask the next question, a quick 30-second answer from you. What kind of comfort does a global brand like that, being a large partner, even if not a majority partner, have from that individual project perspective for an equity shareholder?
So what it does, Niraj, is a huge level of financial de-risking. Because these are annuity flows. So what really Max Ventures does, or Max Estates does, is it secures the project, ring fences it, gets the approvals out of the way, and then you bring in a financial partner, so that you get capture a lot of the long-term upside upfront.
Got it. Okay, Ashwini, over to you. Next question.
Yeah. So Sahil, just digging deeper into the commercial aspect of the business. 2-3 years from now, you will have roughly about 300 crores of rental income from the projects, and that this is after taking out the share of Max New York Life of New York Life. Sorry. So what I wanted to understand from you was that how do you uh, see how do you want your viewers to value this business, or what kind of valuations do these kind of rental streams attract? That's number one. And number two, how do you think about recycling the capital? Because once the project is stable and it has all the tenants in and it's earning regular rentals, would you think about rotating out of that and redeploying the capital somewhere else?
A great question, Ashwini. So to answer your first question, the valuation of commercial assets has now become more transparent, has now become more public and more open, if I can call it that. And the REITs in the country have, and also globally, have played a very strong role in being able to do that. We already have a few REITs that are publicly traded in India, and there are a few more in the pipeline. And therefore, there is a clear valuation benchmark at which those REITs are currently trading at. It is at a certain cap rate, and obviously the cap rates do move with what is the growth expectation in the portfolio, and what are the interest rates, in the environment in that sense. So the REITs provide a fair benchmark, while they may vary slightly between different REIT and that's REIT to REIT. But for us at Max Estates, we're very confident that a valuation benchmark at a certain cap rate that you can see as a benchmark, which already exists in the REITs, is a fair assessment to look at a capitalized value of the rental income that we have. To answer your second question, which is about how do we think about capital, I think it's a great question, because one of the biggest challenges in the commercial space is the high intensity of capital that is required. And you don't see inflows till after you finish the project and start leasing. And therefore, the strategy, if you see that we've taken a partner, which is New York Life, in our office space. Second, what we look to do is that the minute we complete the project and we are able to lease it out, we do what is called the lease rental discounting. So while in our balance sheet, and I can share some more details there, it will show as debt, but that debt is effectively discounted lease rentals. So it's a little bit more conservative in that sense, and it's obviously lower cost as well. So it's discounted lease rental. So that lease rental discounting enables us to recycle the capital for the next projects as well.
Thanks. And now, just shifting gears and getting into your residential space, you've announced two projects, one in Noida and another one in Gurgaon. And if I look at these two projects, maybe I think 18 months from now, please correct me if I'm wrong, you should start to see the project launches and the sales starting to come through. Again, your live well philosophy will be at work here. You've had an experience of delivering properties in Dehradun. And the question I wanted to ask you is that what will be your positioning, and what kind of profit margins can one expect in this business?
Yeah, no. So yeah, absolutely. So we have two projects, as you correctly mentioned. One is in Noida, which is 1 million square feet, and this is an outright acquisition that we did. And the second is in Gurgaon, which is 2.5 million square feet that we have acquired through a joint development route. And we are anticipating to launch our Noida project in the first half of the calendar year this year, and Gurgaon in the first half of the calendar year next year. And therefore, what we are looking at in terms of our positioning is for this to be a very so if you look at luxury, premium, affordable as three segments, we are wanting to position ourselves between the premium and luxury segment. So very upper premium, as very close to luxury in that sense. And the idea is that we want to be able to provide an ecosystem that enables the residents to live well. To do that, we know that there's going to be a certain cost to it, and therefore the positioning and price points are in that range. If I were to say what that translates to, it's in the range of 15,000 to 20,000 rupees a square foot. I know sitting in Mumbai that doesn't qualify as upper premium. That will probably be affordable in Mumbai, but in the NCR that is the upper end of premium. And we believe that at that segment, that we can provide great value for money by providing an ecosystem and an environment that is more luxury in nature, but the price points at upper premium price point. The ticket size is also not exorbitant, and therefore we are keeping an eye on velocity as well. And therefore, keeping this price point, we are hopeful and confident that at least 25% should be a realistic margin on the residential business moving forward.
Okay, great. Just two questions. One is that just to share with your viewers, your targets are 1 million square feet of residential and 1 million square feet of commercial space delivery per year. And that should start to become visible fiscal 25 onwards. Sahil, would that be right?
Absolutely. In fact, Ashwini, I will say that in this year, as we start selling Noida, we will be disclosing our sales collections. And therefore, if one were to extrapolate that, because from a real estate accounting perspective, the accounting of that from a revenue perspective will only happen when we deliver the project. But the collections of that are a very clear indicator of how the accounting will work, because the sales would be crystallized to a large extent. So that will in itself start giving indications of how this is going to be looking like. So yes, in the next 1 year, we'll get indication of sales, and obviously the accounting will take place 3 years from now.
I'll just take one last question, Sahil, and which is a two-part question, maybe the right to win. So your brand name is strong, but in terms of the executable quantum that you have done till now versus what you are aiming to do, it's a wide chasm, right? So what gives you the belief that you will necessarily be able to execute all of these things well? That is part one. And part two, would it be fair to assume that the targets that you have on operating earnings are significantly higher 4 to 5 years down the line, looking at the things that you've told us on the show?
Absolutely. So I'll answer the first question. The what we have done, if you look at it, is in real estate, and if you look at history, as long as the balance sheet of the company is strong, actually the delivery is not so much of a challenge. So it's the capital and delivery that is extremely important. That the capital and the balance sheet strength is extremely important, which I spoke about what we've been able to build. The second is practically executing it, and therefore we have actually grown in a calibrated way. We completed 2 million square feet over the 3 or 4 years, built the team, built the capability, and now are doing the projects. And even if you look at the scope of our projects, it's one office and one residential each in Noida and Gurgaon. So it's very calibrated and calculated in that sense. In terms of earnings, absolutely. You see, today, like I explained, because of the accounting methodology, the residential revenue is only recorded when the project is completed. So one will be able to see how that is moving with the sales traction that we are able to do, and with the continuing lease out and the build out of our office portfolio. And then finally, just one thing I did not mention, both in terms of risk and in terms of the portfolio, is that as we have seen, having a commercial and a residential mix is always very healthy. If you look at some of the companies that have been able to tide through some of the cyclicalities, even though they were not as strong in terms of balance sheet back then, they have been able to tide through that because of the strength of the commercial office portfolio. So the way to look at it is, while in the short term, sometimes maybe commercial may look like a drag on return on equity on the balance sheet. If you look at from a long-term perspective, from a risk-adjusted basis, it's always a very healthy balance to have both. And from a long-term perspective, we are very confident that the return on equity on commercial also shows up eventually. So therefore, from a risk perspective, from an execution perspective, from a bandwidth perspective, we believe that to manage and to have a balance of both the commercial office portfolio, which we have de-risked through New York Life, have a residential portfolio that we've de-risked through the joint development and outright approach, the capital balanced approach, which we've bought everything from equity in terms of land, and we will borrow limited way for lease rental discounting, which we believe is safe debt and limited construction finance, and the strength of the team and the brand, continuing to strengthen the brand, we believe is our recipe, and we hope that it'll work out.
We wish you all the best for that, Sahil, and look forward to talking to you post your earnings once you start giving the pre-sales numbers starting quarter 1. All the best.
Thank you very much.
All right. That's a fair degree of insight from the management itself, Ashwini. Now, the same question to you. As an equity investor, targets seem tall, right? Both in terms of the deliverables, in terms of million square feet or what have you, and the fact that the operating numbers released thus far are not very large. So it's virtually small cap, so to say. How confident can you be looking at your studies and hearing this management right now that they can actually reach a number on operating earnings which could be 5x, 10x, 4-5 years down the line?
So, obviously, what I'm basing a lot on, what the management has shared in terms of its plans. And a lot of these details are available on the company's websites and through the earnings presentation. So it's all public domain knowledge that I'm basing this on. And I have visited the 2 commercial properties that are up and running. They are really very, very good properties, and they earn premium to office spaces which are in the same vicinity in both those instances. And knowing how Sahil thinks and the kind of team that he's built around him and the plans he has, I feel reasonably confident that on the commercial spaces side, the quality of the office space that they aim to build and deliver will attract pretty decent rents. And therefore, if I just take the rentals in the spaces, in the areas that these projects are coming up, and I benchmark a small premium to that, then the numbers look fairly achievable on the commercial side. Again, on the residential side, the proof of concept is a very limited one. They've done a project development in Dehradun, which was, I think, 19 bungalows. But again, very, very feel good, look good, premium type of a residential space, and the kind of numbers that Sahil shared with us in terms of per square foot pricing and the profit margins. If you were to apply that to the kind of development plans that are firm and on place, then I think delivery can happen. So, again, to restate what I had said to Sahil as well, typically real estate companies have faced a difficulty either in execution, where they've taken on regulatory uncertainties, or in financial discipline, where they've invested way more than what the balance sheet could support. And on both these fronts, I believe the management is doing the right things. Now, of course, there are always uncertainties in business, and something can always go wrong. And that's the risk of investing, especially in real estate, and that we'll have to see what happens.
Ashwini, great talking to you, and thanks for these insights on a very interesting player within the real estate space. We didn't get a chance to talk about the investment thing, Ashwini. If you want to quickly develop on it for 30 seconds before we wrap the show.
Okay, cool. So they had a small book of investments, and they wanted to do some investments related to commercial real estate. So specifically startups in hospitality, in restaurants and things like that. They've made one investment in Azure Hospitality, which runs some restaurants, and they've taken a write down in the annual report in fiscal 22. So I was hoping to ask Sahil, what he wants to do with that. The amount is very small, it's negligible. The current investments, I think the written down value is about 30-40 crores or something like that. So on a 1,500 crore equity investment, it's nothing, not relevant. But I wanted to ask him, how he feels about these investments going ahead. So we'll see how that plays out.
Some other time, but maybe I'll ask him on one of the interviews as well. I'll remember that. But Ashwini, thanks for these insights. Lovely talking to you today, and look forward to having you more often on the BQ Prime platform.
Thank you, Niraj. Thank you for having me over and discussing this idea. Hope your viewers will find it interesting.
Oh, most certainly. Most certainly, viewers. I hope you find this interesting. Thanks so much for tuning in to yet another episode of Insight.